Today, we're going to talk about the positive stock bond correlation, what it is, and what it means for the average investor. First, let's talk about the 60/40 portfolio. This has become a staple amongst investors and money managers over the last few decades. All it is splitting your assets into two buckets: 60% in equities and 40% in bonds. The purpose of the 60/40 is to diversify risk across two opposite asset classes, where equities are risk and bonds are safety. Equities tend to do best when the economy is in good shape and growth is rising, whereas bonds, on the other hand, do best throughout recessions where growth is declining. Since 1928, the 60/40, consisting of the S&P 500 and 10-year US Treasury bonds, returned 8.8% per year on average. For this portfolio to be effective, though, you need an environment where the stock bond correlation is negative. If bonds go down, you want your stocks going up and vice versa. The problem is pretty much throughout all of 2022, the stock bond correlation was positive. This was one of the primary drivers in the horrible returns we saw, with the 60/40 closing the year down 17.5%. It's important to note that the stock bond correlation fluctuates with time, and that's consistent or stagnant. We've seen many periods of positive and negative correlated regimes. It's when the stock bond correlation goes positive, though, that's where things are likely to get screwed up. For example, if we go back to the 1970s and we take a look at a chart with the SPX and we run a correlation study against the 10-year US Treasury bond, we can compare the correlation between the two. We can see between 1973 and 1974, the SPX fell with a positive stock bond correlation, and the 60/40 during this period returned a negative 20% return. Remember what I said earlier. The reason this portfolio is used is because of its diversification between the two assets. Once that correlation goes positive, you now have your entire portfolio susceptible to fractional risk, with the downside being the one concern. At Market Radar, we saw this coming in early 2022 and made numerous posts and comments on Twitter, alerting that the bearish markets across both bonds and equities were going to be problematic for market. We made it very clear that both of these asset classes had great downside risk and will likely see lower prices as the inflationary recession, also known as stagflation, takes hold in the economy. Now, some of you might be concerned about last year's performance on the 60/40 and are wondering if the portfolio will ever spit out similar historical returns in the future. To answer your question, yes, I do believe we are going to see a rebound. I do, however, also believe that the 60/40 is the lazy man's portfolio, and simply using a few indicators, you can do better yourself. For example, the positive stock bond correlation coupled with the bearish market trends across bonds and equities with accelerating inflation was a pretty obvious and easy signal to sidestep the mess and move assets to cash last year. You can now re-enter your positions after the dust, putting yourself in a much better position to reap the benefits of the rebound. Also, if you have an advisor, please make sure you're not using a 60/40 portfolio. It's very easy to do yourself, and there's no reason you should be paying management to rebalance a portfolio either quarterly or even annually. Makes no sense. You could do this yourself and save yourself some capital.